If the share price then increases back to what it was, you've made profit again. Making sense? Okay. So in that case, you have 6 cents as opposed to 50 cents. So it's a very unique strategy, that one, in the sense that it increases your return without increasing your risk. It's actually lowering your risk. Because if you're renting out this share month after month, then your share price from 16 actually gets lower and lower and lower every month you've actually rented it out, because you're getting income back. So it's technically one way to buy a share at a discount. It's also one way to generate extra revenue off an asset base that's just sitting there that people don't necessarily know about. So any guess, if you have any quick questions, I'll just answer a couple of questions on this before we move on. Does anyone have any quick questions?
I was just wondering, how can you pick, I mean, I know the home study course would teach you a lot of the strategies on how to actually pick them, but how, if you were just looking in the newspaper and that, what kind of things would you be looking for?
As far as the share that you'd buy?
Yes.
Or as far as the rental and things like that?
I just want to get them at the moment, and then we can look at what we're going to do with them. But how would we? Yeah.
So what we do in our seminars and also on the home studies, we go through an example. We pull out the paper. Now, most of you, when you actually get doing this, you probably won't even use the paper. You just be taught to do it online and stuff like that. So we had the newspaper here, and so we had the time. You'd be able to go through it. And what we do is get you to make those decisions. In other words, look at the share. Giving it a live example. Look at the share as an example, what you could rent it out, etc. Then let's say you got 100 grand. Quickly, between you and the person next to you, pick what shares you're going to buy and what you're going to rent it out, and use some examples like that. It really doesn't take that much to figure out. You can rent them, for instance. You can rent them at, the higher you go up and rent them, okay, the less likely your shares are going to be sold. You go, that's great, okay? But the less rent you're going to get. So the rent up here is going to be maybe 10 cents, okay? So you're going to get less rent, but less likely to get your shares sold. Or if they do get sold, you're getting a higher price, so you're making more capital growth on your shares. Okay? So that's what you would look at initially when you get started. Then you go into more depth and you just use judgment. You say, okay, if you think the share price is going to jump to $20 this month, would you rent it at 17, yes or no? Judgment, you go, well, you can't making a profit. Okay, so you still make a profit. So some people say, oh, the downside of this strategy, it minimizes your capital growth. Great. If that's the downside, then that's a good thing, isn't it? Okay, it's better than going broke. Okay, you do potentially minimize your capital growth. Okay, true. But what you can do is you get better with judgment, is you go, okay, well, I'm thinking it's going to jump to 20. I'm just going to wait. Wait till it jumps to 20. Then I'm going to think it's going to stick around there for a while, then start renting. Okay, that's when you get, but some things when you're learning to ride a bike, you need to get on the bike, and at least what I would suggest if you're going to do this, you paper trade it. So when you study the home study, etc., you start paper trading. You pretend you bought this, you rented it out, you see at the end of the month what would have happened. Okay, do that until you're confident. Then start with a small amount of money. Don't go and mortgage the whole house and put everything onto it. Okay, be intelligent, start with small, you build up your confidence, and then when you're on the bike, you start to learn a few extra distinctions. Okay, what was Jamie talking about, that brake before? Maybe I should have listened. Okay, what's that braking? What's these gears for? Oh, I mean, I can actually go a little bit easier if I knew that. So you start to learn those extra distinctions. But part of learning is also you have to start doing as well. There's only ever so much, so we teach as much as we can to get you started into action, and then you continue your learning as a result of that. Okay, now, making sense? Now, a lot of people say, well, who's going to buy and rent our shares off us? Okay, so it's done through the market. You don't have to have Simon's mobile number and say, Simon, you rent my shares off me. There's a market there for that. For most shares, that will vary depending on the share that you're using. And you can see that before you buy a particular share, what the rental market is. So before you buy that, you can see how much the rent is, thereabouts, before you did it. Some of you already own shares and thinking, you know what, I had shares for years. I didn't know I could rent them out. I've just been waiting on the dividend check once a year. True? And you could actually been generating some extra revenue, which you weren't even aware of. Works great in a flat market, works great in a slightly rising market, okay? Often share is. If the market is getting very volatile, you're going to adjust your strategy slightly, okay? So what you often do, and what we're taught, is buy cheap insurance. In other words, you're buying cheap insurance where you can protect as the market crashes, you're protected. Okay, I'm not going to go into that as a strategy now. I'll go through that again with members, etc., so you're clear on that. I don't want to confuse you with that. But what you would do is you'd have cheap insurance. Okay, you can protect yourself with that. The other thing that we use with this strategy is that if you don't own shares yet, you can actually make a promise to buy some shares. So instead of paying $16 for the share, you want to buy this share, so you might make a promise in November to make a promise to say, okay, I want to buy this share. I want to make a promise to buy it at, say, $15, and for that, you're going to get paid money. So let's say you got $1.50. End of November, you're making a promise. You haven't owned the share yet. I want to make a promise to buy the share, like say at $15 as an example, and you can get paid money up front for doing nothing other than making a promise. Money paid into your bank account. Who likes the idea of that? Okay? You can actually just say, Jamie, that I can just make a promise and get paid money into my bank account. Yes, what's the catch? The catch is this. You're obligated to fulfill your promise. Meaning if the share price dropped below $15, at the end of the November was below $15, your promise is that you'll buy it at $15. So in other words, you're the insurance company in this case, you can do that. You're providing insurance to someone else. They're saying, I want to protect my shares at $15, I'm willing to pay some money for that. Okay, so then you get some money for that. But if you're willing to buy the shares at $16 anyhow, you're like, well, I want to buy it at 16. Instead of buying at 16, I'll make a promise and end up buying for that. Does it make sense? Okay, so that's another strategy we can add on to it, but let's, if you're new to this, you want to at least get started, understand the basics, and then you can add the other strategies onto it by studying in some more detail, okay? Now, the other thing you can do in the share market as well is you can also use capital growth strategy, okay? So if it's a volatile market or you think the market, look at the market today to what it was 12 months ago, can you get shares at substantial discounts today, yes or no? Massive discounts to what they were. Is there shares out there that are trading well below what they're worth? Yes or no? Yes, okay. And so you can also do a combination of strategies. So you can do a capital growth strategy. So for myself personally, what I'm doing right now, going to the market in a big way, because I see a lot of buying opportunities, you can use strategies, did you know, where you can borrow up to 100% effectively in the market. So if you don't want to use your own money, you can borrow. People say, but if you're borrowing, isn't that risky? Well, all I'm doing is adopting a property strategy and taking a property strategy and applying to the share market. In property, what's great about property, you can borrow up to 100%, 80, 90, sometimes 100%. True? What's great about property, why they allow you to borrow more? Because generally property doesn't crash. Okay? This is a property crash in Australia. That's a crash. True? In some cases, it might have went down a little bit because it was overpriced, but pretty much that's a property crash. Share market crash, different, isn't it? Okay? But if you study history, at the bottom of the market, within 3 years, generally, the market's risen 80, 90, 100% back up above its previous high within 3 years. Okay? September 11th, it rose back up within 3 months. Do you realize? So property market is different. So in the property market, you'll borrow more and you'll feel, because property is safe as houses, you'll feel more certainty that it's not going to collapse to 50% of its value. Unless, of course, you live in America, okay, when they have a property market collapse. But that's because they did some pretty dumb things over there. When you're loaning money to people that can't afford it, don't have a job, don't have an income, what do they call them, the ninja loans, then what do you expect to happen? So what you have here is that you can apply the same principle to share market as well. You can get up to 100% leverage, and you have the safety of property in the sense that you can capital protect your position. So if you were to borrow $1 million, say, and say, Jamie, you've been borrowing $1 million going to the share market, but have complete protection knowing that the share price falls, it doesn't hurt you. Who'd like the idea of that? We can have complete capital protection. You can protect your downside. The only risk would be your interest costs, okay, which your dividends offset, and your insurance costs. But then that's a tax deduction anyhow, so you're getting some of that back. But your only risk. So if you bought $1 million worth of shares, you don't have to have the $1 million to do it, and then the share market rose 30% in 3 years. You've now got $1.9 million worth of shares. Who likes the idea of that? Okay. Now, is there any guarantee of that? Yes or no? Well, the share market crashes and it's now only worth 500,000. Have you lost 500,000? Or what have you lost? You haven't lost 500,000 because whatever you buy the shares at in this strategy, it's protected, so downside doesn't matter.